Good morning. This is James with 77 Financial Group. You're listening to 15 Minutes of Finance, where in the next 15 minutes, I bet I can get you excited about investing. Let's do it. All right. Happy Saturday, everybody. We are back at it again. We missed last week, so we got stuff to cover. We got inflation news. We got tariff talk. We got stocks that did well. We got stocks that we talked about 2 weeks ago that have done exceptionally well. We got crypto to the moon. We got all types of things, all-time highs. We had 4 days of back-to-back all-time highs. Crazy stuff. Also really exciting, right? Because just about 3 months ago, boy, was it depressing. It was April 1st when he did or was it March 1st? Either way, the tariff destruction of the stock market that happened a couple of months ago, it seems to be over, right? And the second rates get lowered, the second war ends in wherever the 1900 places on earth there's a war, the stock market is going to absolutely explode, okay? And you can say that I banked on that. Now, does that mean it's not going to be tumultuous and pretty volatile in the meantime? No, but I still think it's going to trend upwards pretty significantly. But remember, 3 times minimum every year, the market drops 5%, right? So even in years where it's up 30%, 3 times it's gone down 5%. So there is always volatility, and you just have to take a deep breath. And remember that this is not a sprint. It's not a marathon. It's one of those crazy, ridiculous David Goggins 100-mile ultra races. Okay, that's what this is. And if you're able to remember that just like runners have runners' highs and runners' walls, we too, as investors, have walls and highs, and we have to remember this too shall pass. And if you're able to focus on that, I promise you, you'll become exceptionally successful with your financial goals. Okay, let's start with the term of the day before we get to the news. And the term of the day is robo-advisor. So a robo-advisor is an automated investment platform that uses algorithms to build and manage a portfolio based upon your goals, risk tolerance, and timeline without needing a human advisor. Some key traits here are low fees, often 0.25 to 0.5%, uses ETFs or index funds, automatic rebalancing. There's some tax loss harvesting benefits for a higher fee usually, and there's no emotional bias. That's probably the most important one. Runs entirely on data. So, and easily accessible, right? Robinhood, Betterment, Wealthfront, SoFi has stuff, Schwab has stuff. And I wanted that to be our term of the day because, I mean, that's going to be the future, right? Is these robo-advisors. And I'm not trying to talk crap about them because I still think they're better than 95% of financial advisors, right? And if you know us, we're not afraid to talk crap about other people in the industry. And the reason for that is because you either are in the industry maleficent, right? Which I think is you're malicious. We'll use malicious. You're either malicious or you're ignorant, and you can't attribute to maliciousness what you can attribute to ignorance. So a lot of these advisors just have no idea what they're doing, and they've been trained in these sales sound bites, right? Insurance people there are people who think insurance is an investment vehicle, and it's not. It's always a protection vehicle. And you'll hear, well, that's what the ultra wealthy do. The ultra wealthy have already made their money. They're not doing it to make money. They've already done that. So it is literally still an insurance policy. But that's how they get regular people. Anyways, I'm ranting again about that. But the robo-advisor, why that's important. All that is an algorithm, right? There's nothing special about their thinking and their thought process. It's not ChatGPT saying, I wonder if today we should buy Tesla. No, they're just putting you in index funds and ETFs, which is all going to be the same. There's probably going to be 5 different risk tolerance portfolios that they put you in. And as robo-advisors grow, it's just going to be the same stuff they're putting people in. And guess what happens when everybody's invested in the same thing? Let me tell you what happens. The 2010 flash crash, Dow plunged nearly 1,000 points in minutes. A large sale order triggered high-frequency trading, which escalated selling in a feedback loop. Okay, massive volatility and billions of temporary losses and some actual losses. The night capital meltdown. This is probably the biggest one. A flawed algorithm executed erratic trades in 148 stocks. Over $440 million was lost in 45 minutes, bankrupting the firm. Okay, we can do the ETF flash crash. Opening bell chaos, ETFs dropped 30% in minutes before recovering. Algorithmic trading failed to price ETFs correctly due to an underlying asset confusion, resulted in new rules for ETF pricing and circuit breakdowns. Or how about the Robinhood outage that occurred during COVID? Robinhood went down during the biggest one-day point gain in Dow history. Users couldn't trade or access their portfolios. The meme stock frenzy, right? All of a sudden, the algorithms weren't working and GameStop could just stop your trading. All of these things are going to be concerns moving forward with the robo-advisors. You don't want to be exclusively in that camp. Now, with that said, I still think robo-advisors are better than 95% of financial advisors. The biggest difference is they can't really use, and this is arguable, so this is just my opinion, they don't really use fundamental data. And they're not, well, they do use fundamental data. They don't use qualitative data. That's how I'll put it. So it's strictly going to be numbers and projections. Okay. And one thing you know, or you're about to know, because I'm about to tell you, is risk and reward, risk and return, they're never known ahead of time. Never. Risk is something that you'll only know looking backwards. You can try to guess it. It's hypothetical. You know, you can guesstimate, but you'll never know it until it's already happened, right? Because if a stock goes up 1,000%, looking back, you're like, oh, I should have done that. There was no risk because it went up, right? And then reward, you don't really know until after the actual the return you're going to get. Return and risk are not known until after, right? Hindsight 2020. Okay, let's read the news. How long do I got? Oh, geez, I got 7.5 minutes. I am making this one under 15 minutes. Okay. Major U.S. equity indexes were mixed heading into this week as a report showing an uptick in consumer sentiment suggested that unease over possible tariff impacts could be dwindling. The S&P 500 wavered through Friday's session before ending with a minimal loss of less than 0.1%, wrapping up the week just below Thursday's closing high. The Dow dropped 0.3%, while the Nasdaq eked out a gain of less than 0.1% to complete a sweep of 5 record daily closes this week. Investment manager Invesco, IVZ, filed a proxy statement asking shareholders of the Invesco QQQ Trust for permission to restructure the Nasdaq 100 tracking fund. The proposed reclassification of the massive tech-focused exchange-traded fund to an open-ended fund from a unit investment trust could boost Invesco's fee revenue while lowering costs for shareholders. Invesco's shares surged 15%, posting the S&P 500's strongest daily performance. I know that made no sense to most of you, but a UIT is just a very specific investment where an open-end, think mutual fund, where you can buy like $1 of a mutual fund. I think minimum is actually like 50, but a lot of these closed-ended UITs funds, you can't really do that. The price is what the price is. You can't buy a piece of it. Shares of Regions Financial, RF, advanced 6.1% after the Alabama-based banking company beat second quarter profit expectations. Year-over-year growth in net interest income and fee income contributed to the strong quarterly results. Power producer Talon Energy, TLN, I don't know if that sounds familiar to anybody who listened last week, announced a $3.5 billion deal to acquire a pair of gas-fired plants in Pennsylvania and Ohio. The move is part of the energy infrastructure firm's portfolio expansion efforts as it aims to position itself to meet demand from power-intensive data centers. Talon stock soared more than 24% on Friday. It's already an expensive stock, and they soared 24%. Shares of nuclear power players Vistra and Constellation Energy, which have drawn attention for their own data ambitions, were up 6.1% and 4.3% respectively. Dell Technologies, this is another one that I'll talk about here in a second. Dell Technology shares powered some 6% higher. Analysts at Bank of America said the tech firm could come close to doubling its earnings per share by 2030. B of A believes demand for artificial intelligence and infrastructure from business and government entities, along with resurgical capital spending on cloud technology, could drive an acceleration in revenue growth for Dell over the next 5 years. Elevance Health ELV shares plunged for a second straight session, shedding 8.4% on Friday. The downswing for the insurer stock came after Elevance cut its full-year guidance, citing high costs related to Medicaid and Affordable Care Act coverage. Other health insurance stocks joined in the two-day swoon following Elevance's reduced forecast. Shares of Molina Healthcare, MOH, posted a Friday decline of more than 10%, following the furthest of any S&P 500 stock. Netflix shares sank 5.1% in the wake of its quarterly earnings release. The video streaming giant topped net income estimates and lifted its full-year revenue guidance. Netflix said its operating margin would be lower in the second half of 2025 compared with the first half of the year, reflecting higher content amortization along with more sales and marketing costs involved in promoting a wider roster of content during the third and fourth quarters. That just means we're going to get more Netflix shows. Manufacturing conglomerate 3M, ticker MMM, posted better than expected sales and profits for the second quarter and raised its 2025 outlook. Although the strong numbers initially helped push shares of the Post-it notes maker higher. Excuse me, guys. The stock changed course during 3M's earnings call as executives discussed sluggishness in the global economy and a challenging environment for the company's consumer electronics and auto parts business. 3M shares ended 3% lower. Okay, first off, Dell. Oh, well, okay, that's the news, right? Nothing was really talked about negative. Pretty much all stocks. Exciting stuff. Some things I do want us to watch for the upcoming couple of weeks, because Trump's talking about new tariff stuff, right? He's threatening stuff. EU might get 15%. We don't know what's happening with China. Though NVIDIA might get to sell chips in China again, which if that happens, that stock's going to continue just to keep rising, boy. That's gonna be a killer. But these are the things I want you guys to watch. So we got to look for inflation. Okay, if inflation stays low, if we can stay steady there, we're looking at some good rate conversations with the Fed. July and August, the tariff talk, we got to focus on that. So the Fed commentary, that's huge. Earnings reports, that's the most important thing for the stock market. Now, all these tech companies have extremely high expectations, right? So if there's a earnings per share expectation of 15 cents and they get 16 cents, you'd like, oh, they beat earnings. That's great. No, they're going to need to shatter some of these companies. Palantir, for example, probably going to need to shatter expectations to really see any boom, just because the PE ratios 600, 550, somewhere in that range. 660, I think, was the last number I saw. But I promise you, if we can get a rate cut in September and then maybe one in December, 2026 is going to be an insane year for just unexplainable growth. Again, that's assuming all things equal. Okay, don't put my feet to the fire if we have a war, if China invades Taiwan. All right, there are obviously extenuating circumstances that dictate this stuff. Okay, let me go back to the stocks real quick. Guys, listen to our last episode. I gave you all the stocks we're watching, and I want to add Dell to that. So I really like Dell. They're making the move in the infrastructure AI space. Dell is a very well-known name. We all know Dell, okay? Especially if you're a millennial. You grew up with Dell in your classroom. I remember we had like 10 Apple computers and 7,000 Dell computers. Made no sense. We had 2 Dell computers for every one student. Or if we had 7,000, then I guess it would be like 2.5 Dell for every student. But really like Dell. I wouldn't say I'm ready to put money in it, but I am watching it. And then Talon. Guys, we talked about Talon last week. Let me go to my stocks Apple list here. TLN and CEG. We brought both of those up. Okay? That is, they make they provide the energy for the AI companies. That takes an immense amount of energy, right? These are fundamental, foundational players in the tech space. Yes, you could look at their fundamentals and their one might be better than the other. They're both doing the infrastructure. They're like the threads of the rope. Okay, they're providing the threads. It's very important that understand the assembly line of these companies. This is one of the first people at the assembly line, one of the first tools that gets put together. Okay, so it's at the very foundation of the AI tech stock boom. They're very important. And yeah, TLN went up 24%. Did I know that was going to happen? I had no idea. I just knew I liked what they were doing. The fundamentals looked good. And also their business model is great. The business they're in, the market they're in. Those are the things you have to focus on when you're picking stocks. Do you even like the market, right? I'll tell you, the boring markets, waste management's a great example. La Quinta, those are boring. Hotels and poop, waste management, waste, trash. I don't know why poop came out of my mouth first, but waste management, that's boring. But guess what? They've been some of the best earners since 1980s. La Quinta in particular in the 80s with Peter Lynch. But you want to find the boring stuff. Okay, the boring stuff tends to make money. Now, it's also fun to be in the exciting stuff. But I'll tell you, Palantir, as exciting as it is, was absolutely boring for 20 years. NVIDIA, absolutely boring for 20 years. Okay, I am over my time. Guys, we'll be back next week, all right? We learned a lot today. I hope you remember robo-advisors. They're better than most financial advisors. And if you're looking to work with one, please look at our other episodes. We give you questions to ask, exactly what you need to know if they're going to take care of you or not. And if you're not sure, reach out to us. We'll help you. Okay, guys, that is it for today. As always, invest early, invest often. We'll see you next week.